Hello everyone and welcome to this session dedicated to the Starbike case study. This case aims to allow you to synthesize your comprehension of transfer pricing mechanics. Starbike is a group that manufactures and distributes bikes worldwide. The group was historically specialized in the manufacture and distribution of wheels only, but merged in 2010 with a company specialized in the manufacture and distribution of bike frames. This operation allows the Starbike Group to offer its customers complete bikes, frame plus wheels, that complement each other perfectly. The manufacturer of these complete bikes is the essential company for which the group has been able to make a name for itself in recent years in the highly competitive bike manufacturing and distribution market. Indeed, the manufacturing process of Starbike bikes integrates a unique derailleur system that requires a real complementary between the two manufacturing plants in France, Company A, and in Switzerland, Company B. The two factories therefore perform intertwined functions, assume joint risks, and each one holds strategic assets in such a way that it is not possible to distinguish the value created by each in the manufacture of Starbike bikes. In addition, the group is regularly asked by independent companies to use the Starbike brand on bike accessories such as water bottles, jerseys, helmets, etc. The group accepts that independent companies use its Starbike brand for bike accessories in exchange for the payment of a brand royalty of 10% of the revenue generated by the sale of these accessories. The group is organized as follows. Company A, located in France, and Company B, located in Switzerland, are jointly in charge of manufacturing bikes. Company A is in charge of manufacturing the wheels, and Company B is in charge of manufacturing the frames. Company C, located in Ireland, owns the trademark Starbike. Company D, located in France, is in charge of the distribution of bikes throughout the world and of the exploitation of the Starbike brand. Please find a group presentation detailing the companies that are part of Starbike Group, as well as their location and function performed in the group value chain. The lines also represent the existing transactions involving Starbike Group entities, for which transactions a transfer price should be determined. The transactions for which a transfer price should be determined are the intercompany transactions, which means the transactions between group Starbike entities. In this respect, a transfer price should be determined for all transactions except the transaction between Company D, the distribution company, and the end customers, as the latter are third parties. Indeed, a transaction between independent parties is considered de facto as arm's length as a result of free market conditions. In 2020, the group has made an annual turnover of 100 million euros entirely generated by the distribution entity in the group, Company D. The production costs of Company A are 15 million euros and the production costs of Company B are 20 million euros. The costs associated with the brands borne by Company C are 2 million euros. Accordingly, the initial situation of group entities' income statement before any transfer price is determined is as follows. Company D records the external turnover of 100 million euros. Company C incurs brand development costs for 2 million euros. Company A and B incurs production costs for respectively 15 and 20 million euros. A transfer price is a price adopted for bookkeeping purposes, which is used to value transactions between affiliated enterprises integrated under the same management that affects the profit allocation between those enterprises. Please note that for simplification purpose, we will consider in this study case that the gross margin and the net margin are the same. How would you proceed to determine these transfer prices? As you may know, the analysis should be performed transaction by transaction. For each transaction, the steps will be the following. Step 1. Functional analysis. The objective of this step is to understand the functions performed, risks borne, and assets owned by each party involved in the transaction. This analysis should be performed in the light of the market specificities. Step 2. Characterization. The functional analysis then allows to determine an entrepreneur and a routine entity. The entrepreneur will be the company with high value-added functions and which supports the highest risk. The entrepreneur will also be the entity that develops and owns key assets, especially intangible assets such as know-how or patents. Accordingly, the entrepreneur will be the entity with a more complex functional profile, for which a comparability analysis will be more complex to perform. The routine entity, on the opposite, will be the one performing standard functions and bearing limited risk. A comparability analysis will thus be easier to perform. Step 3. Economic and financial analysis. Following the characterization of all parties involved in the transaction, one can derive the more appropriate transfer pricing method to be used and the resulting profit allocation. On one side, the routine entity has a less complex functional profile. It will thus often receive a standard remuneration that will allow to cover its costs and achieve a guaranteed margin. The level of the guaranteed margin will be determined based on comparison with the margin achieved by independent entities having a comparable functional profile, as well as business activities. On the other side, the entrepreneur will receive the residual profit or loss after remuneration of the routine entity. Let's start with the transaction 1. As transaction 1 refers to the use of the Starbike brand owned by Company C, we can assume that the functional analysis may focus on the Starbike brand itself. The functions that can be identified for Company C, the company in charge of the development of the intangible, are the following. Development of the intangible, which notably includes the definition and modeling of the brand, visuals, colors, the definition of the characteristic and the positioning of the brand compared to its competitors, or the development of strategies related to the brand. Second, function enhancement, which includes the conduction of analysis and market researches aiming at identifying factors related to developing the brand's recognition. The implementation of rebranding activities, if needed. The definition of offers aiming at conforming to market changes and users' expectations. And the elaboration of offers aiming at enhancing users' loyalty and reducing users' volatility. Maintenance function of the intangible. The performance of strategic marketing activities related to the brand, the organization of events activities, the performance of operational marketing activities related to the brand, as the development of sponsorships and ambassadors with international sports celebrities, for instance. Last one, protection of the intangibles through legal protection, filing and renewal of the trademarks, as well as involvement in legal actions in case of counterfeit. On the opposite side, Company D is only using the brand in the framework of its sales and distribution business activities. In this respect, Company D directly benefits from the use of the Starbike brand, as it allows Company D to distinguish its offer from its competitors and to benefit from Starbike notoriety. Accordingly, the characterization of parties involved in the transaction is the following: Company C, licensor; Company D, licensee. Let's now consider the most appropriate method to determine the intercompany price to use the Starbike brand. As recommended by OECD guidelines, the cut method should be the preferred approach when possible, as the most direct method to determine an intercompany price. As stated in the introduction, the group is really regularly asked by independent companies to use the Starbike brand on bike accessories. And the group accepts that independent companies use its Starbike brand for bike accessories in exchange for the payment of a brand royalty of 10% of the revenue generated by the sale of these accessories. Accordingly, we can notice that Company C is also granting the right to use Starbike brand to independent companies. The price settled is a royalty rate of 10% of the turnover generated thanks to the use of Starbike brand. As both transactions can be considered comparable, we can use the cup method and use the same price for the intercompany transaction between Company D and Company D, which means 10% of the turnover generated. Application of the selected method. We thus have a royalty fee that should amount to 10%, multiplied by group external turnover equals 10% multiplied by 100 equals 10 million euros. Here is the addition of the transfer price determined for transaction 1 in the profit and loss statement of group entities. Let's now consider transaction 2, which is the sale of finished products from both Company A and Company B, the manufacturing entities, to Company D, the distribution entity. The functions that can be identified for Company A and Company B, the companies in charge of the manufacturing of the bikes, are the following: supply chain management, manufacturing planning, integration of the unique derailleur system, and quality control. Company A and B notably assume the risk of manufacturing defects and own manufacturing processes and know-how. On the other side, the functions that can be identified for Company D, the company in charge of the distribution of the bikes, are the following: marketing strategy, distribution strategy, order management, pricing, sales, and after-sales services. Company D notably assumes customer insolvency risk and owns customer relations. There are two options for the characterizations that we will both analyze. Option 1, Company A and Company B, the companies in charge of the manufacturing of the bikes, are characterized as the routine entities, and accordingly, Company D, in charge of the distribution of the bikes, is considered as the entrepreneur. Option 2, the opposite, Company D, in charge of the distribution of the bikes, is characterized as the routine entity, and accordingly, Company A and Company B, the companies in charge of the manufacturing of the bikes, are considered as the entrepreneur. Both options are the opposites in terms of characterization. Let's start with option 1, where the manufacturing entities are the routine entities. As no comparable transaction between unrelated companies can be identified, the CAP method is rejected. In option 1, Company A and Company B, in charge of the manufacturing of the bike, are characterized as routine entities. Accordingly, Company A and Company B will be the tested party for which we will look for an arm's length margin they should achieve for their manufacturing functions. Two methods can be used. First one, cost-plus methods that consist in the analysis of a targeted gross margin based on a markup applied on the costs incurred. Second one, TNMM, that consists in the analysis of a targeted net operating margin based on a markup applied on the total cost incurred. In this case, the TNMM is applied with a net cost plus profit level indicator. As gross margin and net margin are the same in this case study, the use of the cost-plus method or TNMM is the same. What are the criteria to determine if a company can be considered as comparable? To identify companies that can be considered comparable, we will have to look at three comparability factors. Independence of the company. The first one is independence. We are looking for margins that are only affected by the core activity of the company, without potential transfer pricing effect from internal transactions. The company must thus be independent and not part of a group. Functional comparability. The second one is a functional comparability. The comparable company must have functions, risk, and assets similar to those of the tested company. In other terms, the comparable company's role in the value chain of the product, has to be similar to the tested company's role in its own product value chain. Third one, the last one, is the comparability of the services or goods. The comparable company must operate in a similar market to the tested company. In our example, we thus look for companies that are independent, performing manufacturing functions, and manufacturing bikes or related products. Comparable 1. Velo Rodeo is an independent company in charge of manufacturing racing bikes. Is it independent? Yes. Is it performing comparable functions? Yes, manufacturing. Is it manufacturing comparable products? Yes, bikes. Velo Rodeo can thus be accepted as a deemed comparable for the transaction analyzed. Comparable 2. Kayak Rodeo is an independent company in charge of the manufacture and distribution of kayak. Is it independent? Yes. Is it performing comparable functions? No. Manufacturing and distribution functions. Is it manufacturing comparable products? No. Kayaks. Comparable 3. Rodeo Fast is a company of the Rodeo Group in charge of manufacturing water bottles targeted at sports enthusiasts. Is it independent? No. Is it performing comparable functions? Yes, manufacturing functions. Is it performing comparable products? No, water bottles. Accordingly, comparable 1, Velo Rodeo, can be considered as a comparable company to determine the appropriate margin Company A and Company B should achieve for their manufacturing functions. We'll thus use the margin achieved by Velo Rodeo, 4%, to determine an appropriate transfer price. As the production costs incurred by both Company A and Company B are 15 plus 20 equals 35 million euros, the appropriate transfer price will be 35 multiplied by 1 plus 4% equals 36.4 million euros. Indeed, a transfer price amounting to 36.4 million euros will allow the manufacturing companies to cover their costs and achieve a 4% operating margin. Company D will then earn the residual profit. The impact on the income statement of both companies are detailed in the slide. Let's now contemplate option 2. In option 2, Company D, in charge of the distribution of the bikes, is characterized as a routine entity. Accordingly, Company D will be the tested party, and we will look for the arm's length margin Company D should achieve. Two methods can be used. Resale price method, which consists in the analysis of a targeted gross margin computed on the turnover generated by the company, and transactional net margin, which consists in the analysis of a targeted net operating margin based on the turnover generated by the company. In this case, the TNMM is applied with a net operating margin profit level indicator. As gross margin and net margin are the same in this synthesis case, the use of the resale price method, or TNMM, is the same. In order to determine an appropriate targeted operating margin, we will perform a benchmarking analysis while looking at the margin achieved by comparable companies. In option 2, we will thus look for companies that are independent, performing distribution functions, and distributing bikes or related products. Comparable 1. Veloda is a company in charge of the distribution of bikes manufactured by Drive Fast Group, of which it is part. Is it independent? No. Is it performing comparable functions? Yes, distribution functions. Is it manufacturing comparable products? Yes, bikes. As it is not independent, we cannot use Veloda as a comparable company. Comparable 2. Velodu is an independent company in charge of the distribution of bikes manufactured by the Big Fives group on the European markets. Is it independent? Yes. Is it performing comparable functions? Yes, distribution functions. Is it distributing comparable products? Yes, bikes. Velodu can be considered as a comparable company for the analyzed transaction. Comparable 3. Velody is an independent company in charge of designing fully custom-made bikes. Is it independent? Yes. Is it performing comparable functions? No, design functions. Is it distributing comparable products? Yes, bikes. As it is not performing comparable functions, Velody cannot be considered as a comparable company for the analyzed transaction. Accordingly, comparable to Velody can be considered as a comparable company to determine the appropriate margin company D should achieve for its distribution functions. We'll thus use the margin achieved by Velody, 6%, to determine an appropriate transfer price. As the turnover registered by company D is 100 million euros, the appropriate transfer price will be 100 multiplied by 1 minus 6% equals 94. Indeed, a transfer price amounting to 94 million euros will allow company D to achieve a 6% operating margin. Company A and B will then earn the residual profit. The impacts on the income statements of the involved companies are detailed in the slide. In order to determine which option to choose for the characterization, we asked the group management. The group management replied as follows. The Starbike Group is chosen by consumers who are concerned about the quality of their bikes manufacturing and for the unique derailleur system that is integrated during the manufacturing process. In addition, the research and development carried out by the companies in charge of manufacturing the bikes is strategic for the group. The distribution teams are therefore only in charge of the distribution of products manufactured by the manufacturing companies and under their strict control. What option will you choose? You understand from the group management that the more important are the manufacturing functions which are performed by both Company A and Company B. Accordingly, Company A and Company B should be characterized as entrepreneur and Company D as routine entity. The option to choose is this, option 2. Here is the table with TP analysis process completed for transaction 2. Regarding Company D, we analyze in transaction 1 that Company D is paying a royalty fee amounting to 10 million euros to Company C, the group entity owning Starbike brand. However, as determined in transaction 2, Company D should achieve an operating margin of 6%. In order to ensure Company D receives 6% of guaranteed margin, we will then adjust the transfer price with Company A and B, the companies in charge of the bikes manufacturing. Accordingly, the intercompany transfer price for transaction 2 will be adjusted to 84 to account for the 10 million euros royalty fee paid. Thanks to this adjustment, Company D will still receive 10% of operating margin despite the increase of its costs with the brand fee. The slide details the addition of the transfer price determined for transaction 1 and transaction 2 in the profit and loss statements of group entities. Let's now consider transaction 3. Transaction 3 refers to the joint manufacturing of bikes by Company A and Company B, and accordingly how to allocate the 84 million euros transfer price determined previously. As stated in the introduction, the manufacturing of Starbike bikes integrates a unique derailleur system that requires a real complementarity between the two manufacturing plants in France, Company A, and in Switzerland, Company B. The two factories therefore perform intertwined functions, assume joint risks, and each one holds strategic assets in such a way that it is not possible to distinguish the value created by each in the manufacture of Starbike bikes. Company A and Company B interact closely in the performance of functions related to bike manufacturing. It is thus not possible to identify an entrepreneur part and a routine part. In this framework, both Company A and Company B should be characterized as co-entrepreneurs. In this situation, the appropriate transfer pricing method should thus be the profit split method, which consists in the allocation of the consolidated profit between entities based on their contribution. This assessment should be performed by qualitatively assess for each function the involvement of each company in the functions performed. In order to determine the contribution of each company, we ask the management to list the functions performed, the importance of each function in the bike manufacturing, and the contribution of each company to each function. The table details the profit contribution analysis. As you can see, at the end, Company A contributes to 40%, whereas Company B contributes to 60%. The distribution of the allocated profit should thus be 40% for Company A and 60% for Company B. In order to determine the transfer price between both entities, let's start by computing the consolidated profit generated. Total internal turnover minus total cost incurred, which means 84, the transfer price determined previously, minus 15, Company A costs, minus 20, Company B costs, which equals to 49 million euros of consolidated profit. As a next step, we will determine the profits that should be earned by both entities. Company A, 40% of 49 million equals 19.6 million euros, and Company B, 60% of 49 million equals 29.4 million euros. To determine the transfer price and the allocation of the internal turnover, we should take into account the operating costs borne by both entities with the objective of a margin amounting to 19.6 million for Company A and 29.4 million for Company B. In this respect, the royalty fee allocation will be for Company A, 19.6 plus 15 equals 34.6 million euros, and for Company B, 29.4 plus 20 equals 49.4 million euros. As detailed previously, here is a table detailing the TP analysis step by step per transaction completed for the 3 transactions. Let's now review the impact of all the transfer prices already determined on the profit and loss statements of group entities. Here is the initial situation without any transfer prices. Addition of the transfer price determined for transaction 1. Addition of the transfer price determined for transaction 2 and adjustment required due to transaction 1. Addition of the transfer price determined for transaction 3. As a result of the transfer prices determined, the margins achieved by group companies are detailed in the table. For simplification purpose, we consider that the margin determined constitutes corporate income tax base. Company A and Company D are located in France and will thus be taxed at a corporate income tax rate of 25%. Company B is located in Switzerland and will thus be taxed at a corporate income tax rate of 13.99%. Company C is located in Ireland and will thus be taxed at a corporate income tax rate of 12.5%. The amount of taxes paid by Company A will thus be 19.6 multiplied by 25% equals 4.9 million euros. Same computation for all group entities with their respective CIT rates for their tax jurisdiction. The total amount of corporate income tax paid by Starbike Group will thus be 12.15 million euros. Congratulations! You now know the logic that stand behind transfer pricing issues and the global methodology, as well as the 5 different methods that enable companies to comply with the arm's length principle.